Today, we are going to build off of that first concept with something that advisors refer to as the efficient frontier. Now, at first glance, that might be a term that you may or may not have ever heard of. So in a nutshell, what this refers to is after you have established that level of risk that you're comfortable taking in a portfolio, how do we now optimize that mix of investments so that you are getting the maximum amount of return for that level of risk? As advisors, we constantly talk about this idea of diversification in your investment portfolio. The key role that diversification actually plays is that at any given time, you have different types of investments or asset classes that are performing differently or better than others. And with that combination of investments, you essentially have this mix of investments where the sum is greater than its equal parts. What that really means is that you are optimizing that level of return that you're making in the portfolio for that level of risk that you're comfortable taking. Now, it's very hard to do in a video, but the way that we map this out is something called the efficient frontier. It's a little bit nerdy, but it's essentially this arc that sits on a risk and return axis. And any portfolio that is built that sits on or above that line is truly one that's compensating you appropriately or optimally for the level of risk that you're taking. Now, the real question here is, how do you know? What analysis has been done to determine if your current portfolio is actually compensating you for that level of risk that you're taking? And the only way to do that is to really do a deep dive analysis and get a bit nerdy. So to find out if your personal investment portfolio, whether it's retirement or taxable, is in fact optimized, click the link below and let's dig into some good old-fashioned investment analysis for you.